moving on to another update from the market regulator SEBI, which is now proposed to change the calculation methodology of open interest in derivative space, and this one will be interesting. But what this exactly is and how will this impact the markets? Sajeet, who's an expert on this one, joins in with more details. Sajeet, over to you.
That's right. What the consultation paper of market regulator tries to do is to reevaluate the way the open interest has been calculated, and as a result of which how stocks are entering into ban period. Currently, there is a methodology wherein if your total open interest exceeds 95% of the market-wide position limit, the stock enters into ban period in the FNO, which basically means that you will not be able to take fresh positions and you have to square off your positions. As a result of which, many of the small and retail investors who may be participating get stuck because of that. But now what the regulator is trying to do is, and he's been trying to explain that to this market for a couple of quarters now, that they're going to go into the delta based strategy, which basically looking at sensitivity of the contracts at that point in time, wherein which calculates the kind of open interest based on delta, and which basically marginalizes all the out of the money open interest. And so the open interest which is calculated is for that point of time and that period of the contract, and not which has out of the money, which is second month or third month contracts where the open interest has been created for hedging purposes. As a result of which the open interest requirement will change, and the classification will change, and then our fewer stocks will go into ban as a result of that. But the market regulator is also moving away from the market-wide position limit calculation, which is based on free float of a company, to average delivery of the stock in the cash market, which is basically now linking it to how liquid the stock is in the cash market with respect to with respect to the liquidity which is there, and based on that the open interest would be calculated as well, and that's something which is going to be interesting. It's a consultation paper which SEBI has floated, and it will take a couple of months before it can be approved, and the new transition can come in. It will take a couple of months or quarters there, because there needs a lot of change with respect to softwares for all the brokers and the vendors, and that would be a long run process.
Okay, but Sajeet, stay with us and tell us the impact that this would have on the non-benchmark derivative indices, because that is also important for investors and traders. Give us more details on that one.
Surely, the market regulator has slipped in another regulation as part of this consultation paper for open interest, wherein it says now that non-benchmark indices which are in derivatives, for example, when we say benchmark, it's Nifty and Sensex, and non-benchmark would be the BSE BankX or the BSE Sensex 50. In NSE, it would be the NSE Financial Services or NSE Mid Cap Select or NSE Next 50. These are the benchmark indices, and these indices, if it needs to be in derivative contract, then each index should have at least constituents of 14 constituents to be part of that index. Currently, two indices, which is NSE Bank, has only 12 constituents, and BSE BankX has 10 indices. So these two indices will have to add more stocks and take it beyond 14, so that it's eligible for FNO the contracts going forward. But again, this is a consultation paper which is at present it is done there. The main purpose is to reduce the volatility which is there on expiry days for these non-benchmark indices, because you normally see for Nifty Bank or BSE BankX, few stocks are very volatile, like ICICI Bank and HDFC Bank, which have a higher weightage in the indices, and they become very volatile, and they turn and make it difficult for many of the investors to do that. There's a change in criteria as well. Now the cap of individual weightage for stock is at 22% compared to 33%, and top three is now kept at 45% instead of 65%. So all the diversification of these indices will also bring down the volatility of the stocks, but as a whole the volatility of the index may go up because there are more stocks now to play with.
Okay, thank you so much for that. But Sarvendra, coming to your liquidity point, do you think that this kind of regulation might impact the liquidity, and SEBI is actually trying to curb and maybe protect the retail investors or traders, I would say? I think you're on mute.
Yeah. See, what it will do possibly is that it will give more time, and the funds of the front month will be taken into consideration. So uh, anything which is out of in the second, third month will not be counted. That will allow the stock to trade more. That is what I can. So yeah, liquidity part, I don't know much about it in the sense how much liquidity it will get into the FNO. But yeah, if you trade 4 days more and you are less in the ban period, if you cut the ban period by 2, 3 more days, 4 days more, I think that much definitely goes into that liquidity part. That at least 4 days you trade more and there's some liquidity in the stock. So yes, I think I would take it more positively. As a trader, I would say more positively because you are allowing me to trade more. So that I think it's a good move. It's a good move.
Okay. Avinash, quickly, any thoughts on this one?
No, I think in little lesser liquid counters on the FNO side, there was a lot of artificial built-up in the open interest position. The stocks used to go in ban. So I think this is something which used to be played by some participants, with vested interest. So I think the regulator has done a good job. I think if this consultation paper is approved, then I think it actually helps some of the retail investors, who take positions on the FNO side. So at least from the retail community side, investor side, this is a welcome move. I think we'll need to see how it actually gets implemented, but definitely it will improve the liquidity and reduce the volatility.